Hello, everyone, and welcome to Good Morning Trading for Monday, June 29th in the year of our Lord 2026. A trader speaks to traders. Wall Street is coming off an especially tough week. The Nasdaq has fallen for 5 sessions in a row. It couldn't have done any better. A perfect score. And a question is starting to haunt the trading floors. Are we in an artificial intelligence bubble? And then, this week, there will be just one key indicator we can't afford to miss. The big report on U.S. employment. This Thursday, pay attention, I'll explain why it's on Thursday and not Friday, so stay with me. Until the end, we're going to talk about a finance legend who just passed away, one of my favorite figures. Almost my favorite historical figure in the world of finance. This week we're going to have 3 main issues. There's one area that's really under pressure right now because of fears of a bubble. Have we gone too far? Then there's U.S. employment in a climate where the Fed obviously doesn't want to raise rates. And finally, the dollar, which will be our guiding thread for today, and maybe even for the whole week. Let's quickly go over the markets. So Friday night, Wall Street ended mixed. The S&P 500 was almost flat. The Nasdaq fell by 0.24%. The Dow Jones lost 0.09%, almost flat as well. Only the Russell 2000 slightly gained, up 0.07%. In Asia, Friday saw a big hit, with Seoul plunging nearly 6%, and the safety mechanisms even suspended trading, again linked to Samsung, which took a heavy blow. In Europe, as usual, the session was in the red. The CAC lost 0.55%, and the Euro stocks 0.69%. This morning, it looks like things are trying to rebound, a bit more positive. Now, let's look at our little barometer of the day, what we'll be watching. For me, it's the dollar today. Why? Because we measure it against the major world currencies, and in a way, it's the tide that can lift or sink American assets. So this week, last week, it hit a peak. Its highest level in 13 months. And why's that? Well, it's because the U.S. Central Bank has taken a tougher stance, wants to raise rates. It hasn't done it yet, but it wants to. So, naturally, money is flowing in. People are buying dollars so they can invest them when interest rates go up in the United States. It went up all week and then lost a bit of steam on Friday. But there you have it. Just keep in mind something very simple. The more the dollar rises, the more it signals that investors think the Fed is going to raise rates. And if rates go up, that's generally not good for the stock markets in the United States. And second, it's really not good for tech stocks. If they have to borrow their billions, their tens or even hundreds of billions each year at much, much higher rates, just do the math. If your interest rates go up by 0.25 or 0.50 more on 100 billion in loans, that starts to add up pretty quickly, We're talking about an extra $500 million to pay, and it adds up fast. $500 million. Did I say dollars? No, that's not possible. It would be a 50% increase in borrowing rates. So right away, you're looking at $50 million. Sorry, that's 50 million more to pay, so we're talking tens of millions of dollars. Every little change is 0.20 or 0.25%. So that's the paradox right now. The Fed is raising rates, which of course supports the dollar. The greenback is hesitating, but a strong dollar is especially important for us traders, and also for us as consumers. Why? Because it makes raw materials more expensive. Since we pay for our barrels of oil, whether you're in Asia, the West, Africa, South America, and so on. We pay in dollars, so if the dollar is more expensive, we're going to have to pay more for a barrel of oil. We'll have to pay more for copper, and so on. So there you have it. Now, let's get to today's topic, this whole week. This week really comes down to one big event, the U.S. jobs report, as I mentioned. So it's coming up, and it's moved up by a day because of July 4th, which is a holiday. July 4th is a holiday in the United States. It's the day. It's Independence Day in the United States of America. This year falls on a Saturday. But since they want to celebrate it, they make Friday a holiday instead. just like every last Friday of the month. Normally, we get the U.S. jobs report then. But this time, the report is pushed forward by 24 hours, so it comes out on Thursday. Heads up, it's a short week, only 4 trading days, with the U.S. stock market closed on Friday. Closed! So this week is going to be a bit hectic. The consensus is expecting about 170,000 new jobs to be created. This month. Why are we waiting for this number? Why is it so explosive? It's because of what I explained earlier about the interest rate environment. We're not in the usual scenario. The Fed isn't preparing to cut rates. For years, we've gotten used to rate cuts. They've considered raising them. They've kept rates steady. The last FOMC meeting was... Don't tell me. I'm calculating it right now. It was 15 days ago, on a Wednesday, June 17th. But... Emma, how should I put it? Sorry. During the Fed chairman's press conference, he hinted that the decision to keep the rate steady wasn't unanimous, and that just under half of the Fed officials actually wanted to raise rates. So maybe not this time, maybe not the next time, but we're definitely going to take a hit in the coming month. In September. So if inflation stays too high, we're at 3.4, that's above 3%, then the Fed might raise rates, and that's not going to be very good. And why do these employment numbers matter? If the United States creates a lot of jobs, that's an inflationary sign. It's a sign that the engine is overheating, at least above 3%, and that will reinforce the idea that they're going to raise rates. So at Barclays, for example, there's an economist named Mark Giannoni. I'm guessing he's of Italian origin. He sees employment. What about that? It's accelerating, since the average per quarter has been above 150,000 jobs. And let me remind you that at the beginning of the year, we were at 73,000 jobs. So what does that mean? It means that the American job market is creating twice as many, actually a little more than twice as many jobs. Possible. And when you have a lot of possible jobs, that's inflationary. Because if you want to snag your engineer, if you want to snag your baker, ouch, when there are a lot of bakeries that want bakers, a lot of companies in AI that want engineers, to attract people, they're going to have to offer perks. Well, listen, you'll get a car. Listen, yes, I'll give you a raise. How much is that bakery offering you? Okay, I'll give you $500 more. So, it's an inflationary push on salaries. And when people have more money, what do? They spend more, so that drives inflation even further. And that's why the Fed is a little bit worried that corporate profits are rising. No problem with wages going up, but that still bothers them a bit. Little bit. Still, it's also kind of important for wages to go up a bit. Let's move on to our technical analysis, if I can find my buttons. And there we go. So we're looking at the NASDAQ, which I talked to you about last week, especially about the monthly middle, almost all week. We hit it once, bounced, almost hit it again and started to bounce, and then hit it once, twice, and we started to bounce. And overnight, last night, we almost touched it. It came down to 5 or 6 points, and we bounced again by nearly 350 points. So the metal and its monthly level is really, for now, the lower ceiling that's allowing us to bounce. So it would be great if this afternoon, in 7 or 8 hours, it started to go back up there. Honestly, I don't really believe it. But in that case, we would have another opportunity. Or if it goes to test 25,200, the lowest point from last week, which is not far from 25,150, we could have another setup. A bounce, and we could make our day just on that little bounce that will last 3, 4, 5 minutes. And that's it. We don't talk about it anymore. But you'll need to be patient and wait for it. But potentially, it's the trade with the highest success rate. But let me remind you that no trade has a 100% success rate, so there's always some risk. But we limit the risk a little because we have the past to go on, where we've seen there was a reaction, but be careful, the reaction is getting weaker and weaker. So the solution is to try to catch it a little lower than usual, just to attempt a re-entry at the support based on the monthly test, and that should be enough. If it goes above, it picks up speed. If we're done for the day, we just let them have their fun. But be careful, there isn't a good setup over the next 2 weeks. That looks really tempting. We have a pretty clear downward trend line, so be careful when we come back into contact with that downward trend line. The algorithms can kick in and trigger a little wave of decline. Moving on to the European markets, well, the CAC 40 is the same. Monthly resistance, bounce, 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 bounce. We're right on it. We might open slightly above it, so keep an eye on this area. We're holding it. We're actually in a good spot. Looking at a 2-month profile, the CAC 40 is pretty much at its highs. So that's pretty positive for it. For once, the DAX. Here too, we have a small profile. That wasn't the one I wanted to show you. So we have a slightly bearish profile over the past 15 weeks. The downward trend line is there and in play. Be careful, once again, if we come back into contact with the downward trend line, it could be an opportunity for short sellers to wake up. And then, especially for buyers, it's a chance to take their profits, or a large part of their profits, to lock them in. That's always how it is in the stock market. When things go down, you never really know. Is it really people short selling? Selling without actually owning the shares? Because they think everything is going badly and the market is going to crash? Or is it simply people who plan to buy at a lower price and are taking their profits now, which makes the prices drop? And the opposite happens when prices go up. It's people entering the market who didn't have any shares before, who are very optimistic and think the market is going up. I see a lot of positive signals, so I buy. Or it could be short sellers who are cashing in their profits, for example here at a low point, which helps the market go back up. And most of the time, it's a mix of both. On the Dow Jones, we're actually pretty low, but we're still in a good spot because even though the Nasdaq dropped 5 times in a row last week, the Dow Jones still hit its all-time record high, above 53,000 points. So you can't really say it's not doing well when it's just a little bit down, a little over 1% below its all-time high. And let me remind you that the Dow Jones is the oldest index. In the United States, it's pretty much the oldest index with continuous trading. It's almost always running. It's one of the oldest in the world, so we do have a bit of perspective on it. It's not an index that was just created 3 days ago. And when we say it's the all-time record, right now we're at the absolute record. I'm in the middle of counting 19th, 20th, let's say 21st century. So over 3 rolling centuries, not yet finished. We've hit the all-time record, so the Nasdaq is doing really well. As we've seen, the S&P 500 is also holding at its monthly support. On the other hand, it's slipping a bit more, showing a little more weakness at the monthly support. But it's holding up well, and apparently it wants to go for its middle and its monthly level. If they stabilize there, that'll already be a good thing. It would have avoided breaking its monthly support. You see, it was still really tough to hold on to those 7,400 points or so. A little less so now. Well, listen, nothing's really happening. They've managed to stay just a bit above 4,000. We had a small rebound that went up to 4,100, and now we're around 4,050. It's trying to stabilize on its monthly East 3 level. There aren't any particular signals on gold, except that I said there's a good chance it'll just range for a while around $4,000. Well, now it's starting its second week right at the 4,000 mark. There are no bullish signals on Bitcoin. Same thing here. It's been 2 months of decline. It dropped. It went down from 82 to 59. It lost 25% of its value in 2 months, and there's no sign, like when there's real buying interest, despite all the influencers trying to get as many people as possible to start buying. There's just no will. Pretty much at the lowest point of the year, the annual lows. And right now, there's no will, no spark. There's not even much desire left, apparently. So we'll see. But honestly, if there's not much desire left and not a ton of new people coming in, who's actually getting involved? The king, king is stabilizing at its current levels. Just to remind you, for old folks like me, Bitcoin isn't anything revolutionary. There was already NASA's CTI project, which had already done all of this. Back then, people participated for free, and it was all about searching for extraterrestrials. There you go. The older folks remember that. With our computers, it must have been PC 300s, something like that, or 486s. Yeah, it was more like 486 DXs, or 386 DXs. That's right. We were already mining individually to help NASA find extraterrestrials. That was the era. X-Files, right? Well, we didn't find them, but they're out there somewhere for sure. And as for the price of a barrel of oil dropping below 70, that's not a very good sign for the global economy. Cheap oil, happy consumers. What was it I wanted to tell you? Well, that's about it. We've covered everything. Just the daily update. Here's nothing. Today, it's quiet, nothing going on. There's absolutely nothing. No major statistics, no big results. I think it's the calm before Thursday's storm, so watch out. Thursday is when things will move, that's for sure. Tomorrow, Tuesday, things will start to pick up a bit. We have the United States Consumer Confidence Index report and the JOLTS report on private sector employment opportunities, which is being very closely monitored by investors right now, and that's all scheduled for this coming Wednesday afternoon. We're really in the employment period with the ADP Private Employment Survey, and on Monday there's the ISM Manufacturing Index, which is very important. So today there are no statistics at all. And then things gradually ramp up. Tuesday, an important stat, Wednesday, two important stats, and Thursday is the peak. That's the highlight of the week with the jobs report, which has been moved up. I've already explained to you about the 24-hour shift. Now, a little commercial break. Back in the day, we used to call that an ad. If you want to come to my trading seminar in July in Andorra, it's fully booked. Too bad. Sorry for you. Then there won't be any more, so you missed your chance. Oh, well, that's an ad where I get nothing out of it. Actually, no, sorry, you missed your chance. Now, let me tell you today's little story. I was a bit saddened. Someone who meant a lot to me. Intellectually, someone I really adored because he had a sense of humor. I never met him. I'll tell you right away. But he had a biting sense of humor, just the way I like it, with a lot of culture. And he would answer journalists, and the young journalists didn't even realize he was making fun of them. And I love that kind of humor. A little bit intellectual with a touch of refinement, which sometimes leads to misunderstandings. But there you go. If you didn't know, that should have been the headline in the major newspapers rather than "A plane has crashed." A legend of finance. We've just lost, in my opinion, a legend of finance. Alan Greenspan passed away at the almost respectable age of 200. He could have done more, though. For the younger ones, let me remind you that he ran the American Central Bank for nearly 19 years. He spent a fifth of his life running the American Central Bank. To give you an idea of the respect he commanded in the profession, he was nicknamed the Maestro. El Maestro. So there you have it. And he started, well, he had plenty of style and plenty of charm and wit. Honestly, I really liked that about him. I would have loved to meet him. He's kind of like a grandfather to me. In a way, he was helpful. He was brilliant in '96, and that was true at Christmas. In December, he coined a famous phrase. He did. He spoke about the irrational exuberance of the markets. So basically, he thought the stock market was way too expensive. December 1996, let me remind you that the internet bubble was in 2001, so already in December 96, 4 years earlier, he was warning about it. At first, the markets trembled because of what he said, but then they kept climbing for more than 3 years. And the internet bubble didn't really burst right away. It just started to lose steam a bit. Then after that, it really just completely exploded. So in 2001, the lesson is pretty clear. Spotting excess is easy. There is currently an excess in artificial intelligence. Everyone knows it, But knowing when this excess will end is absolutely impossible. So keep that in mind during this AI frenzy. There will always be analysts who say, I told you so, I told you so. But yes, because analysts don't actually trade. They do 10 analyses a day. 10 analyses a day. So over a year, they do more than 3,000. And they always make sure to have both bearish and bullish analyses. And then what do? They'll pull out one they made 2 years ago about this or that. So I don't take part in this totally ridiculous game, but if they do it, it's because it works on people. It works on people. So yes, I'm predicting for you that there's an artificial intelligence bubble that's gonna explode very precisely. I'll even give you the day. I'm being nice here. It will be on BIP. There you go. So let's move quickly to the next little page. So this week, caution is going to be our ally. We shouldn't rush before then. On Thursday, they'll be waiting for that famous employment report, which could change everything because inflation is at stake. Are we still creating jobs? A lot of jobs, quote unquote, too many jobs in the United States. That's going to force the Fed to raise rates, which will put AI in a tough spot since it's already struggling to hire engineers. They're forced to pay them more, but if rates go up, borrowing will get more expensive. You see, it's not a good deal that can be easily wrapped up. So keep an eye on the dollar. That's what's going to set the pace for us. And remember, a strong dollar also means expensive raw materials, and that's inflationary too. And that encourages the Fed to raise rates. So if the Fed raises rates, that pushes the dollar up, which pushes up raw material prices and pushes up inflation. But what can the Fed do in these situations? It raises interest rates. Yes, and there you have it. It's not a virtuous circle. Keynesian, it's exactly the opposite. Well, there you go. Thank you for sharing this moment with me. Once again, I was very talkative. Big hugs. See you tomorrow. Ciao.